So they are changing my favorite tax credit, hopefully your favorite tax credit as well. They are changing it, they're ruining it. How are they changing it? What's the implications? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. If you're a Wise Money fan, you know I have a favorite tax credit, and because I'm a geek like that, but I love the retirement savers credit. I love it. I love it. I love it. It doesn't apply to everyone. It applies for just a unique season of life, maybe even just 1 year or 2 years. But gosh, when it applies, it is just music. It is awesome, and I'll explain why in just a second. But guys, they're changing it. Not immediately, not for a couple of years, but they've ruined it. They've ruined it. I'm going to explain those changes right now. All right, so here's how it works. The retirement savers credit, known as the savers credit, retirement contribution savers credit, it's got all sorts of names, but here's why I love it. It is a tax credit, okay, so deductions are good. Tax deductions are good. Every deduction saves you a percentage of tax, right? So if you're in the 22% tax bracket and you have a $1,000 deduction, you save 22% of $1,000, so $220. So okay, so fantastic. That's awesome. So deductions are good. It's a proportionate tax saving, but credit is great. Credit is great because credit's a dollar for dollar reduction in your tax bill. So it's not a proportionate, it's not a percentage, it's a dollar for dollar. It's fantastic. Retirement savers credit is giving you a tax credit, so great, for saving up for retirement, for something that you want to do anyway, something you should do anyway. It's not something you need to pay back. It's not something that gets clawed back. You save up for retirement while meeting other qualifications or parameters, and bam, you get a tax credit for saving up in your own retirement. I love it. I love it. So where was it apply? It does not apply to everyone, okay? The biggest threshold is there's an income limitation. By income, adjusted gross income. So not just earnings at a paycheck, it's you and your spouse, your total tax return, front page number, although that they've changed the tax form, so it's very different now, but your adjusted gross income. You've got to be at least 18, you can't be a student, can't be dependent on someone else's return. You can't say, well, I would be a dependent on mom and dad's, but I'm gonna go get this retirement savers credit, so I'll just claim myself instead. Nah, that's not how that works. So, but typically it's really in the early stages of your career, or if you're in between jobs, or maybe at the end of your career working part-time. If your adjusted gross income is below a certain limit, okay, and I'm going to show those in just a second, then you get a tax credit on your tax return of up to 50% of the first $2,000 that you contribute towards retirement. And by retirement, 401k, yeah, IRA, yeah, Roth IRA, yeah, that works too. Any of those, up to 50%. If your income is above that initial tier, then you could get a 20% credit. If it's above that tier, then you can get a 10% credit. So it goes down, your tax credit goes down the higher your income is. And then if your income is too high, then it goes away completely. All right, so for tax year 2023, so not looking back at last year's tax return that you're doing right now, but for 2023, if you're married filing jointly and your adjusted gross income is below $43,500, then 50% is the tax credit on the first $2,000. So this is married filing jointly. So what that would mean is if you contribute $2,000 to a Roth IRA and your spouse contributes $2,000 to a Roth IRA, you each get a $1,000 tax credit. So you combined contribute $4,000 to retirement, you get $2,000 back on your taxes. That's huge. Now, married filing jointly, how many of you will have adjusted gross income below this threshold? Well, again, it would need to be some unique circumstance, but it can apply. If you're single, then your income would need to be below $21,750 in order to get that 50% credit rate. Now, to the 20% credit rate, there's just a small window for that. You can see that here. The 10% credit rate, that's where it gets a little bit looser, okay? So if you're individual, up to $36,500. If you're making less than that, if your adjusted gross income is less than that, then you get a 10% tax credit. So that's still $200 on $2,000. If you're married filing jointly, your income, adjusted gross income, could be up to $73,000 and you'd still get this 10%. And again, that's 10% of the first $2,000 you contribute, 10% of the first $2,000 your spouse contributes as well. Where we see people miss this is they weren't even aware, so therefore they only contributed $500 or something like that, so they had no idea. Or the bigger one is they weren't aware, they contributed more than, they contributed $4,000 or they contributed 10% or whatever it is to their 401k. They ended up getting this credit. They didn't really know why, because it was just, automatically put in there by their CPA or the software or whatever, but they didn't realize how it worked, and therefore they contributed $4,000 for their retirement, but they didn't contribute anything for their spouses. Because if your income's going to be below this threshold and married filing jointly, likely you're one income family. Likely that means one of you is contributing to a 401k, the other person is not. And when that's the case, you're not optimizing this retirement savers credit. So work with your certified financial planner on that. Okay, so that's how it works. That's why I love it. They're ruining it. They are ruining it in the Secure Act 2.0. That's right, the 4,000-page omnibus spending bill that changed over 100 tax laws. Buried in it is a change to the retirement savers credit, the savers credit, starting in 2027. Why did they push it out so long? Because it's going to be impossible for them to pull off. Effectively, here's what they're doing. The tax credit, the limitations, who qualifies, what the percentage is. In essence, my understanding is that's staying basically intact. That all those rules that I just reviewed with you, that's staying intact. It's still going to be on the first $2,000, still going to be 50% the max credit, then it will tier down to 20%, 10%. Those income levels are approximately going to stay the same. We'll see over these next 4 years if they change that, but the bone structure of the retirement savers credit is going to be effectively the same. So what are they changing, and why am I pouting? Because instead of this being a tax credit that lands on your tax return, they are going to make it a savers match, where whatever the tax credit is, they're going to put as a contribution, as a match, as a deposit into your retirement account. That is insane. That's insane. If you're thinking at first, oh yeah, that'd be great. I'd love to have that extra money going into my retirement account. I would too. I love it. How are they going to do it? How are they going to get access to your retirement account and make a deposit in there? What if you're contributing just to your 401k? Well, it states in the law that they've got to make a contribution into a traditional account. So does that mean you've got to go open up a traditional account and expose yourself to that added complexity? Who's going to be the beneficiary of that? What are you going to invest in? Where's that account going to be held? Guys, I don't see how they pull this off. I really don't. And also, that means they're going to have access to your retirement. The government will have access to your retirement account where they can make a deposit into it. And that's sort of scary. That opens up a big can of worms here. And so you might think innocently that, no, this is a good thing. I would want, and folks that have this income threshold, they should have these dollars going extra towards retirement so that they've got more dollars growing and invested for their retirement. And in an altruistic, naive sort of way, I totally agree. Except also in the Secure Act 2.0, they built in lots of other provisions giving you access to your retirement accounts even when you're not retired. So if the premise with this big change that is going to create so much complexity it will make your head spin, if the premise is, no, they want people to have more dollars saved up for retirement, then why did they put in so many provisions to say, well, you can get $1,000 out of you can take $1,000 out without having to pay a penalty at any time. Why did they change some of those rules so you have more access to your retirement accounts? Doesn't make sense, guys. It doesn't add up. This is going to create a lot of complexity. For those of you that are eligible for this, you're still going to want to make sure that you optimize it and maximize it and get the most tax credit possible. And then you'll just need to work with your CFP to navigate the complexity of the IRS. Instead of having this credit land on your tax return, navigate how to get it into the proper investment account so that you're saving that for your long term. So work with your certified financial planner on that. We've got 4 years for them to figure out how in the world to untangle this ball of Christmas lights, or all the mess that they've created here. We've got 4 years, so more updates to come as we know more information, but be aware of that. Work with your CFP on it. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.